Altria Group is now trading at around $40. It is down 15% over the last year and currently offers a yield touching 10%. So is this a fantastic opportunity to buy an undervalued company with a very high yield, or are there a lot of risks and regulations with this over the next few years that makes this a very poor investment choice? Today we've got a lot of information to uncover. We've got their latest annual accounts, so we have the December 2023 numbers. We're going to take a look at their top line revenue as well as their bottom line net income to see how this company is faring over the next few years and over the last 5 years. We're going to look at their balance sheet again with that latest annual report. What is their cash versus their total debt looking like? Essentially the health of the company. We'll do a very quick reminder for those that are new in terms of how they're performing against their competitors. We also want to briefly touch upon some insider buying, which we do believe is a bullish signal. As always, we'll look at institutional ownership. We'll touch upon this dividend safety score, which continues to get investors nervous at that borderline safe score. And we have some news articles to run through. Tobacco doesn't have much of a long-term future. We'll uncover some of the risks we see potentially over the next few years. And we want to talk about whether or not disposable vapes to be banned will have a positive or negative effect on Altria Group. And we have some slides here that we want to run through from their latest article, their latest investor presentation that they ran through in New York just last week. And don't forget, as we always do, we run each company through the valuation model. We want to get to our intrinsic value, get to our acceptable buy price given that investor margin of safety, and find out what exactly are Wall Street predicting for the next 12 months. Now, as we mentioned, this company is currently yielding around 9.91%. The forward P is below 8 and is pretty much touching its 52-week lows. Do bear in mind, though, over the last 10 years, you would be up 10%. Granted, it doesn't include those dividends reinvested. Pretty poor investment, and we can see all-time highs. You have to go back nearly 7 years at around $77. So always exciting when we get the latest annual report numbers, and remember, year on year, what we typically target, that 3 to 7% growth. For tobacco industry, before we even look at the numbers, we do know that they are struggling to keep that top line growth. Now, when we take a look, 19.8 billion reported in 2019, December 2023, 20.5 billion. So straight away, over that last 5 years, we see very minimal growth. What's interesting, though, is on a granular level, we see increases all the way to 2021, before a decrease into 22 and to 2023. So realistically, we will look at the last 10 years percentage-wise, but we would say if you factor in inflation, there probably is no real movement to the top line. Now, typically, that would be a very bad sign. We wouldn't like that in a company. But what's really interesting now is when we look at that bottom line net income, they've gone from a loss of negative 1.3 billion to a positive net income of 8.1 billion. The reason why this gets me a bit excited, why some good news here, is because we can see it has gone from a net loss. It did increase to 2020 and then did decrease into 2021, but we see what they have managed to do whilst their top line is fairly flat is increase that bottom line. Now, a little bit inconsistency as we can see from 2019 to 2021, but if they continue to increase that bottom line whilst keeping that top line fairly flat or even increasing at a few percentage points, this is still very positive for investors. So what they are essentially doing in that case is increasing that operational efficiency, whether that's through high margins or low costs. Now, very quickly then, with their total cash versus debt, now we have those numbers. It has gone from 2 billion to 3.7 billion, so their cash position has increased over the last 5 years, although we do note from the previous year it has dropped slightly by around 10%. Then in terms of their total debt numerically and directionally, which is very important to note, it has decreased from around 28 billion in 2019 to 26 billion. So again, fairly positive. It has decreased over the last 5 years, but when we do take a look at that previous year movement, it hasn't really moved massively, around 400 million. It is in the right direction, but we would like to see that total debt reduce, as that will affect that dividend safety that we're about to come on. Again, very quickly, just for those who are new to the channel, we're just going to compare them to the likes of British American Tobacco, which is extremely popular on the channel, as well as a few others. We can clearly see over the last year, Altria Group, in fact, is one of the best performing, and that does say quite a bit, given it is down negative 7%. Essentially, we're showing the whole industry has had negative performance, bar JAPAY, which is up 27%. Now, over the last 5 years, what we can see is Altria Group, again, only up 13%, pretty much nearly in line with British American Tobacco. So when you consider reinvesting those dividends, they haven't had the greatest return over the 5-year period. Please do bear that in mind. We do have VGR, however, with a very strong return of 141%. But for those that are new, do remember that past performance is never an indicator of future. Now, on this channel, what we typically like to do is look at the insider buys and sells, at least 100 shares and over the last 6 months. The reason why we've gone the last 6 months just to find the latest insider movement, and that is from 2 directors' insider buys. Remember, as the GOAT Peter Lynch said, insiders might sell shares for any number of reasons, but they buy for one, they believe the share price will go up. And as we can see here, 2 lots of buys from 2 different directors. Since then, the share price hasn't really moved, and it was around 48,000 and 45,000, so you may say not the largest movements. Nonetheless, fairly positive to note, but again, take it with a pinch of salt. Institutional ownership update then, 59%. We still see a lot more buying, so 5.4 billion selling over the last 12 months by 53.9 billion buyers, so 10 times more buyers than sells. Again, in Q2, the largest buy as we can see. But what I really wanted to point out through this is whilst we see more buys than sells over the last 12 months, in the latest quarter, we are now seeing more selling of this company than buying. So do consider that. It is nice to note over the last 12 months, but also look at the more relevant period. Quarter 4, we do see around 2 billion sales versus around just under 1 billion worth of buys. Now, before we jump into the dividend safety and look at that valuation, I think it is quite important just to take a look at a few articles before we jump into their investor presentation. Now, we have an article from the Motley Fool where they talk about tobacco being essentially a dying industry. There is no real long-term future. Essentially, they are saying that all of these categories within this industry are living on borrowed time. They talk about how the number of cigarette smokers has reduced. So in 2023, they say there was around 12% of US adults who smoke cigarettes, which has come down significantly from around 40% in the 1970s. A lot of people are essentially not smoking. And one of the key things to remember, and I think this is quite vital to note, is that if people don't start smoking when they are younger, then they are less likely to pick this up as a habit when they're older. So a lot of things do make up that essential investment thesis when you are looking at any type of companies. There is a lot of information to understand. Now, in the UK, we have this bill that is looking like is going to get passed, although we can see January 2025 about disposable vapes being banned, and we will talk about why this is very important for Altria Group, as they are finding that a lot of illicit vapes are harming their market share, reducing their income and their revenues from this massively. Time will tell whether or not this will essentially get passed. But we can also see there are other ways that they are looking to reduce vapes or their attractiveness to younger people. Different ways, reducing the use of flavors so they are less appealed to children, plain packaging, and essentially changing the way that vapes are displayed in shops. So lots of interesting laws and regulations that are coming or looking like they will be coming into place in the UK, and other countries will follow, as we have seen. In fact, we've seen other countries start different cases like this in terms of banning cigarettes for those under the age of 18 at a certain age. But it will be interesting to see. One thing that I do want to point out from this essential investor presentation from New York, from Altria on the 21st of February, is that there are a few slides that are quite interesting to understand. Firstly, the US nicotine space, they do say it has remained stable around 1% CAGR, so compounded annual growth rate from 2018 to around 2023. Not the greatest growth rate, although this should be understood. This is that type of industry. We're talking about tobacco. We're not talking about tech. We're not talking about AI. So do understand the type of companies you are investing or looking to invest in. And then what essentially Altria Group are doing to try and get in or increase their top line and not have stable top line over the next 10 years, or in fact decreasing, is moving to a smoke-free portfolio. These are sort of the items that they do currently have alongside their tobacco, their nicotine products, as well as those that are in the pipeline. We have the e-vapor, the Enjoy acquisition. We have the oral tobacco, which is very popular in Scandinavian countries. And we have heated tobacco. This is a new one for me, so this may essentially be something that is going to be rolled out. So it's not like Altria Group are just sitting there twiddling their thumbs. There are a lot of movements in their pipeline that they do hope will increase their top line in the future and bring a lot of value to investors. Now we can see here in terms of 2028, so we're looking at 4 years out, what they're essentially trying to do in terms of that long-term growth is really build on that non-nicotine approach. What their aim is to enter into the non-nicotine categories with broad commercial distribution of at least 5 products by this timeline. So let's take a look now and see whether or not this is adding attractive value. Let's look at some of the financial metrics, and the first one we want to point out from their slide is that they do return excess cash to investors, whether that is not just through the dividends, as we can see that have been increasing, and we'll look at that percentage shortly, but also through share buybacks that we can note here, and again we can look at that in more detail soon. Adjusted diluted earnings per share from 2018 to 2023, whilst they have cherry-picked the data, we can take a look a little bit back, has increased 4.2% on a compounded annual growth rate. So a lot of things to consider here. So let's jump into the essential dividend safety. Let's look at the numbers. Firstly, dividend safety score 55, borderline safe. Market cap 70 billion, so it is a large cap company. When we come and analyse those data for the recession, we see the last recession they increased the dividend. They had negative 50% recession sales. That was much lower than the S&P, which are around negative 12. Although they smashed out that return, negative 20%, much better than the S&P's negative 55. Now, in terms of dividend growth, just to let you know, they have been increasing in line with inflation around that 4% over the last 5 years. 4.3 in August, 5% in fact over the last 5 years, and 2% over the last 20. A little bit disappointing, but hopefully that is a thing of the past, and we can see a mid-percentage increase this year. They're also a dividend king, so they have been increasing the dividends for 50 years or more. Now, in terms of dividend yield theory, we do get that double sign of undervaluation, the yield 9.8 above that 5-year 8, as well as the forward PE 8 above that 5-year 9.4. And we can see, although it's not very comparable in my opinion, consumer staples is sitting at a much higher PE. In terms of free cash flow payout, always good, especially when you look at companies that pay high dividends. You don't want there to be any risks of a dividend cut. You look for below 85%, and that is specifically the free cash flow. Remember, earnings susceptible to manipulation by management through accounting. Nice to note it has been decreasing, 63% in 2023, 79% in 2024. I would like to see at least keeping up in line with inflation. Imagine you're getting a yield of 10% at the same time it's increasing year on year. In line with inflation is very positive, and especially if you consider it to be undervalued, which we'll cover shortly. Free cash flow per share, love to see this increasing over the last 10 years. Not massively consistent, but still moving in the right direction, although we can see 2024 expected to dip slightly, so let's consider that when we are looking at our essential valuation. Sales, again, we did note that their top line has essentially remained fairly flat, although the last 2 years, -1%, -2%, so we can see this isn't a company with rapid growth. But remember, these are all things you need to consider when you are looking not just at your risk profile as an investor, but also at the valuation if this is a company you want to invest in. Total sales 18 billion to 21, and again we did run through this on that slide. They do return that excess cash to investors, 1.98 billion to 1.78, so you are effectively as a shareholder getting more piece of the pie. ROIC, nice to note, it has been increasing, 48% in 2023, 48% in 2022. Very strong for a tobacco company. Very nice to note as an investor or a potential shareholder. Operating margin above the minimum, so nice to note the operational efficiency, 59% over the last 2 years. It looks like it's moving in the right direction as well, which is why we can see, now this is key, this is why we can see their top line may not be increasing at a rapid rate, but the fact that they're improving their margins is why their bottom line net income is also improving. Very, very positive. And free cash flow margin, again, increasing from already a very strong number, 53% in 2023. Net debt to EBITDA then, the earnings before interest, tax, depreciation, amortization. Remember, this is really correlating to that dividend safety of score of 55 above, as well as that balance sheet that we did analyze. What I love, not only is it 1.79, which is below the 3, remember it shows this, the number of years for them to pay off their debt net of cash on hand, but it is also decreasing from the highs of 2018, is expected to remain relatively flat. So personally, there is no real worry with that dividend based on this information right now. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, just to let you know as well, we have released our latest free weekly newsletter article. If you want to grab a copy of this or of any of the other articles, all completely free, click on that pinned comment below and you can get access straight away. So the first model we're using is the Graham's formula. We have the ticker symbol, earnings per share. We have the long-term growth rate, the corporate bond yield, to give us an intrinsic value of around $39. Not far off the current trading price. We do, however, see our first sign of overvaluation. Keep in mind, we're not looking at any of these models in isolation and will conclude towards the end. We then have the multiples valuation model. Companies in a similar sector and size, their PE. We get the average multiplied by the earnings per share to get an intrinsic value now showing signs of undervaluation, just under $50. We then move on to the dividend discount model. Now we have the increasing over the last few years, average growth at 4%. Now forward looking, I've tried to be a lot more conservative, around 0.75%. Now we don't know whether they will continue to increase those dividends if that top line does start to reduce. But again, more conservative than not. We get an intrinsic value of $54, so we have a second sign of undervaluation. We then have the dividend discount model with the free cash flow year on year. We can see the nice growth from 2022 to 2023, a nice 13% bump. Now, average growth just under 12%. Forward looking, I have gone for negative 3%, so I do believe over the longer term, although this might be more conservative, their free cash flow will reduce, so do bear that in mind. And then we get the present value of future free cash flows, considering that discount rate, add them together with the cash, subtract total debt, get the equity value, divide by shares outstanding. We have another sign of undervaluation. Now, do bear in mind, if you grab a copy of this model, you can run through these numbers for your own, whether it's Altria Group, whether it's companies in your portfolio or companies essentially on your watch list by clicking on that pinned comment below. So the intrinsic value here is the average of these four models, and as we can see in today's episode, $48.84, current price around $40. We use that margin of safety of 10%. Remember, 3 criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for Altria, it is a buy up to $44. At 15%, up to $41.52. And at 20%, it isn't quite there yet, although it did nearly get there yesterday. So we see around 15 to 20% in terms of that MOS level based on those estimates and judgments. In terms of Wall Street, well, their forecast is $46. That's their price target over the next 12 months. They see upside, strong upside, in fact, 16%. They do believe it is a buy. Bear in mind, this then becomes an undervalued company, which also yields at 10%. As always, though, do let me know your thoughts in the comments below. Is Altria Group one you're adding to? Maybe one for whatever reason you want to sell and move into a growth or an AI company, or maybe you're on the sidelines waiting for a slightly lower price. As always, if you enjoyed today's content, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.